Hello everyone and welcome back to Structured Products Insights, a new episode. Today I'm very excited because I have someone with me which I know for many years. I followed him, the progress he's done, the impact he's done in the UK structured products market. So Ian Lowes, welcome to our episode.
Thank you. It's good to be here.
Now, Ian has a lot of experience. He's the former managing director of Lowe's Financial Management, an IFA broker in the UK, and has decades of experience. And what I've always been fascinated by Ian is his love for structured products, especially the autocallables. So Ian, I think it's important, right? Because the UK market, I split it into almost three different, right? You have, of course, the private banking market, especially in London. You have the institutional, but of course you have, the UK is a very big country with a lot of people, still a lot of wealth outside London. And I think this is where the IFA market also comes here. Tell us the audience, which is mostly advisors across the world, what is the IFA market in the UK?
Okay, so we have effectively split into independent financial advisors and non-independent financial advisors. It is highly regulated, very professional now, following retail distribution review.
Mm-hmm.
It is seeming to be concentrating in the higher net worth space. So we have a disenfranchisement of the lower net worth potential investors. There's a lot of consolidation in the sector. We're seeing advisor numbers fall. Obviously, there's the usual demographic challenges, which, I've been hearing about the demographic challenges that our sector's been facing since I joined it in the 80s. So I don't think anything's going to change there, but it has become a more appealing profession for new graduates. So in some respects it's growing, in other respects it is declining to the wider population.
Okay, and how do you define the health of the UK IFA market when it comes to structured products?
Stagnant, I think, is probably fair to say. Albeit I have heard reports that there are increasing number of advisors using structured products. I don't think that's come through in any numbers as yet. And seems to be, and has been for many decades now, a polarization. Those that use structures, I think, very quickly accept that they bring a lot more to the party than just the investment return. And those that don't, in some cases, they're stuck in their ways. They cite things like one of the incidents that occurred in the structured product sector 20 odd years ago, or they raise Lehman's as an issue which affected a very small percentage of the UK market, and they dismiss the whole sector because of that. So akin to dismissing the whole of the oil sector because of Woodford, you just wouldn't do it. But I think a lot of the issues are operational. Our UK sector, as far as structured products concerned, has been largely paper-based, unlike many parts of the world where you can simply trade on whichever platform you use. You have largely been unable to do that in the UK. So we are literally issuing paper documents and getting clients to sign them and then posting them off. That is changing, but it has been a fundamental factor.
And we cannot ignore, right? Because regulation, especially in the UK, had a massive impact, especially with the inducement ban. So tell us what happened and your view from the financial advisor community
in relation
to the changes in regulation when it comes to, of course, to the fees that the FCA put in place.
Okay, so in 2012, we had what was referred to in the UK as the Retail Distribution Review. This forced a higher level of professionalism on advisors, higher qualification levels, transparent fee structure in that there was no commission built into any contracts anymore, so it removed any commission bias. And ultimately, the initial estimates were that a third of the advisors would leave the sector. That figure ended up smaller, but I think it was significantly underestimated by many in the impact it would have. Again, the main losers in that sector change is the lower value potential investors, the mass affluent or the mass market sector.
Yeah, correct. But now, it's also important, right? That that industry didn't die. It's still there. Why is it still there? What are the advisors slash their clients looking in structured products that, with all the difficulties that are now that have been in place since 2012, what are the clients looking that structured products still help?
I think a lot of structured product investors are doing so on the back of advice. There is a very restrictive market in terms of direct to consumer. It is difficult, in fact, it's almost prohibitive for a retail investor to invest in structured products without an advisor. Even if it's a case of they're wanting to do it without advice, there is an advisor needed in the loop to sign off on appropriateness. That, I think, is a bit of a misnomer with certain structures. Except that globally there is a huge range of different types of structures, complicated payoffs. Mm-hmm. In the UK, it is a very simple space. Yeah. Standard order calls maturing from the first or second or third anniversary based on the FTSE 100 index. Yeah. Dual index occasionally appear. Stock contracts are very, very limited. It's a very limited market for typically triple stock sector structures. So I think when we get to the very simple space, such as a FTSE-linked order call, that should be a much bigger market than it is, but it's restricted because retail investors need to go through an advisor, and then only a small portion of advisors understand that sector or have any access to it. Yeah. I would like to think that the sector will grow significantly, but there are barriers in its way, which are predominantly regulatory issues.
Is it the regulator or is it the advisors, right? Because you always mention both, which probably that's the correct answer. But if you think about, what actually would move forward? Is just the regulation, or do you think there is some more work to be done with advisors?
There's a substantial amount of work to be done with many advisors. A lot of advisors will not entertain the sector because of previous concerns or because it doesn't fit their business model. When they are presented with the evidence, their views often change, but their business model perhaps won't. Yeah. As far as the regulation is concerned, I think it's time for change. We want to increase a greater investment population. We want to encourage people to start taking some investment risk rather than leaving their capital stagnating on deposit. Yeah. But that needs to be done reasonably. And I think simple autocalls in a diversified portfolio sit somewhere between cash and equity. Yeah. And I think there's a huge market shift that needs to happen and should happen, but it seems to be regulation, and that interferes, I think, with the target market assessment of the bank. Yeah. A lot of the banks will allow structures to be sold on an execution only or a direct offer basis, again, with an advisor signing it off, and some of them will assess that the target market is different. So you can have one bank saying, yes, this is suitable for an informed client, or somebody acting on their own volition who understands the risks and can sign off on the appropriateness. Yeah. And others will say that they are almost identical product, won't pass that muster. It needs to be an advised product or a professional client.
So I've been in the UK for 15 years, right? It's I'd say that I'm almost as British as Portuguese nowadays, and for me it's staggering because I've seen the evolution. I've seen all other countries, including Portugal, the US, across Europe, Asia. Those markets grew, those markets developed. The UK didn't. And I'm not talking about only on structured products in investment solutions. It seems that it's not providing the offers and the capabilities that investors have in other countries.
I think one of the issues is the way they are transacted. Mm-hmm. As I say, I can't speak for the institutional space. We know we can do things differently in the institutional space. But in the retail space, we still have our structured note packaged up into a retail plan format, which is usually applied for on paper. As I say, that's changing, but that has been the way of the past. Lack of adoption from advisors, their business model's not really accepting the methodology. The platforms, you can't trade structures on many platforms. Some you can do, will charge extortionately, some are reasonable. Yeah. But the whole system for the exchange of the notes, right the way down to the custody where the individual is holding it, is a complicated well,
Yeah.
it's arguably a bit of a mess
Yeah.
compared to a lot of other countries.
Okay. 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 But now we also need to talk about the callables. I know you have a passion for the product. You used extensively, right, throughout your career. Tell us why has the autocallables have been so successful in the UK?
Okay, we had structures of varying types introduced in the late 90s, early 2000s. A lot of those were high-raising contracts. They ultimately became known of as precipice bonds. We'd been screaming about these when they were being issued, and when they were maturing, the sector was hit with a bad news wave.
Yeah.
You would think all structured products were toxic, but
Yeah.
about that time, 2003, the very first autocall globally was issued. It was a BNP Paribas contract issued through a company called Premier, and to me, it resonated perfectly. We had gone through a period of market decline from 2000 to 2003. Obviously, we'd hoped we'd hit the bottom, but I'm sure we'd hoped we'd hit the bottom the year earlier.
Yeah.
A contract that was offering an 8% return on the recovery of the market with a 50% protection barrier was very appealing. Now, as it
Yeah.
was, the contract matured after a year with an 8% gain.
Yeah.
But that was the first. It was slow to take off, but by around about 2010, 2011, protocols were the prevalent contract in the UK. I still liked strict digital contracts at the time, but it was on conversation with clients that convinced me that the ongoing potential to succeed, as opposed to the pivotal date at the end, was a much more appealing factor. The sector got to a point where I think there was 70 to 80% of all UK issuance was autocalls.
Yeah.
Now, was it supply or was it demand that pushed that forward?
Yeah.
I think the supply obviously will try and meet the demand, but the contracts were very clean. There was still a lot of confusion in some aspects where we had American barriers and European barriers for quite a period where you had to double check what type of protection was being afforded.
Yeah.
We are now in a position where there are no American barriers used. Everything is nice and straightforward. There are no stings in the tail, and it's as transparent and clear, I think, as it can get.
What makes within autocallables? What makes it easy for advisors to explain, and on the other side, what do they still struggle to explain to their clients?
Obviously, I can't speak for all advisors.
You can talk about your experience, right?
Yeah. In my experience, explaining to a client a portfolio of funds or a particular investment solution compared to an autocall, clients understand the simplified payoff of an autocall much more than they understand the arguably wishy-washy nature of a traded fund. They all want the same thing. They all want as much capital protection as they can get, as much income as they can get, and as much growth as they can get. An autocall gives them something that they can focus on. And we found that by putting autocalls in the portfolio, the client would focus on that and ignore the noise of the fund-based portfolio.
Yeah.
So it would remove a lot of the nuances of the investment process because the clients wouldn't be looking at the ups and downs on a day-to-day basis and worrying. They'd be looking at June the 6th, 2026 for when the next autocall would mature and what was required. And when you get something like COVID and a huge collapse in the market, clients aren't looking at the investment that they made last week thinking I've just lost 30%. They're looking at when will it recover, and if it takes 3 years on a 10% coupon, I'll get 30% then.
Yeah.
Now, obviously, this was not the be-all and end-all of their portfolio, but by the time we'd evolved, we had multiple structures maturing throughout the year in many portfolios. That set the scene for having regular client meetings to see whether they're going to take gains or reinvest gains, and at the same time talk about the rest of the portfolio, do the annual review and make sure everything was going according to plan. So I found it a much easier solution to explain to clients and a much easier solution for them to understand when the maturity happened.
Yeah, that's a very good point. And what is the thing that you think that advisors have difficulty to explain?
I think counterparty risk is always going to be that question. How the bank does it is a question that doesn't come up any more than how does an insurance company provide a whole of life cover. Clients don't ask that. It's a contract.
That's true.
And as a contract, the client wants to understand the strength of that contract.
Yeah.
During the banking crisis, this was obviously crucial. We were fortunate enough to largely dodge Lehman Brothers. I think following Bear Stearns Monday, we cancelled a whole load of applications that were in pipe for Lehman's contracts. We also moved away from Morgan Stanley and Bank of Scotland, or Royal Bank of Scotland at the same time.
Yeah.
So we weren't picking on one particular institution thinking it was going to fail, but
Yeah.
there was a need for a flight to quality. I think understanding that Lehman's went bust with a A rating, it means that an A rating is not sufficient to guarantee any sort of
Correct.
ongoing security. But a client will understand that they're not going to put all their eggs with Goldman Sachs or Morgan Stanley or Barclays. They're going to spread it around.
Yeah.
And at the end of the day, there's a contract everywhere, and your guilt is an obligation where the government are going to repay it. You're relying upon them. They have greater strength. And there needs to be an assessment. You're not going to get a good return without taking some risk. And it's about taking appropriate risk and understanding the potential impact of that risk and the likelihood of the event occurring.
So in your view, right, you've sold hundreds of products. What are the product features within the autocallables that make a difference?
Okay, again, in the UK, we operate a very simple basis. Autocalls are usually callable first, second, or third year. Now, that feature itself can impact the choice because obviously the advisor has a job to do at the point of recommendation. They're going to charge for that, and that often deters them from having autocalls that could mature on the first anniversary because the fee impact gets higher. Obviously, an adapted model will assume that you don't get charged twice within the space of a year, 2 years, but the net results to the client is what they're looking for. Having autocallable from year 2 was the most common. I like extended duration.
Okay.
I'm a big fan of a 10-year term, 8 year if I can, 10 years if I can get it, if not 8 years. It just allows greater potential for a positive outcome. In the UK, only contracts that have matured with a loss. There have been no FTSE-linked contracts that have matured with a loss. There were 4 FTSE-linked contracts that were Lehman Brothers. The recovery rate was something between 70 and 95%. But as far as the terms of the autocalls are concerned, very straightforward. There have been none that have matured with a loss, but there have been around about 15 out of, I think we're on 2,500 now, that returned capital only. They had a termination date at 6 years or 5 years. Had that been 7 years, that number would be 1. And it's, we used to have an analogy. I can't remember exactly what it was, but I would rather cut my apple tree down after it's borne fruit and not before. I don't want someone coming around to me saying, look, you've got to the end of the term, you can have your money back, but if only you had that extra year, you would have been sitting on that win. So the longer duration is my preference. I think one of the biggest changes to the UK market that hasn't been widely adopted yet is the introduction of the FTSE CSDI index. There are a lot of decrement indices, all of which we dismissed until the CSDI index was launched by FTSE Russell. I think that makes a lot of sense for autocalls. It's a 3.5% decrement from a total return basis. So if we have a dividend stream of 3.5% and the decrement's 3.5%, it should perform almost exactly in line with the FTSE. Right. And it has been 99% correlated. But by removing that requirement to speculate as to what dividend stream will be, the bank can transfer they're transferring the risk of variability of dividends, which could impact the performance of the underlying index, onto the client, but the margins also passed on to the client. And we're looking at coupons of 1.5% higher than a FTSE-linked contract. And I think, much as it's a much more complicated explanation, the net result is a better one for the client. That has been the case so far, and I expect that to continue.
So you bring up the banks and the manufacturers, and again, a big part of being an advisor, right, is the access to the manufacturers, to name that people know, right? Even in ETFs, right, people care about where they're investing, who is the manufacturer, right? And within structured products, it's the same. What do you think? What makes an issuer or a manufacturer of structured products credible to the IFA nowadays?
Talking about the manufacturer rather than the issuer?
Yeah. Well, I guess you can both, but I'll say the issuer.
Okay. So in the UK, we have around 10 counterparties. Everything, I think, sits on credit rating. I dispute the claim that an individual IFA firm or a collection of IFA firms can do a better job than the collection of credit rating agencies in assessing that risk. We can argue that the credit rating agencies can't do a fantastic job because we've seen A-rated institutions fail, but we've got to rely on something. And me doing my due diligence on a bank, similar to what Standard & Poor's do, will be inferior in the extreme. There is no doubt that a known name will be more appealing in the retail space. Everybody knows Barclays, everybody knows HSBC. Not so many people in the UK, no offence to Credit Agricole, no Credit Agricole.
Mm-hmm.
Now, that's an education piece for the client. As you see some Canadian banks coming in, these names they're not names in the UK space. Yeah. But they might be stronger institutions, so the advisor's job is to explain that. CDS is a questionable measure. I think if you're using CDS to assess the credibility of a particular issuer, you've just got to, again, look at the banking crisis and see what happened. See the highest CDS for Lehman's that did fail versus the highest CDS for Citi and Morgan Stanley that didn't fail. And by the time you're looking at that, it's too late anyway. So I think a diversified portfolio of strong institutions that are rated as strong or better by several credit rating agencies is about where we're at. And I don't think we can get much further.
So besides the credit rating, is pricing a key factor or service and education?
Yeah, pricing is a key factor, but I'm going to cite again 2008. If Lehman's are offering an 8% coupon whilst HSBC and everybody else are offering a 7% coupon, it's going to play a part in persuading some advisors or some people that the Lehman's contract is a better value contract. There's red flags.
Okay, and let's talk about the red flags, right? Because it's important for advisors. If you had to have your list of red flags when it comes to investing in a structured product, which ones do you use?
I'm going to say again, the UK market has become very, very simple, vanilla, and transparent. Yeah. The American barriers, I think we've seen 1 or 2 contracts with American option barriers in the last 10 years.
Yeah.
They have been pretty much phased out. The charges that are declared on our key features documents are confusing. There's change afoot in that regard. But even when we have the standardized documentation, we end up with a situation where we can have 2 banks striking a contract on the same day with an identical payoff structure, and yet one's disclosing a fee which is substantially higher than the other. Now, at the end of the day, if I'm comfortable with both banks, that fee, or their calculation of that fee shouldn't play a part. But when it comes to assessing from an advisor's perspective and trying to tell the client, well, okay, this one's got a 3% total charge in there, and this one's got a 2%, it adds confusion.
Yeah, so, I can see.
Falling credit rating is going to be the main red flag. The structure of the contracts, all of the nasty stuff that used to happen 25 years ago, where we would have an extended settlement period, both before and after, worst of, based on the lowest index position intraday over a 30-day period, that sort of thing, long gone. This is a very clean vanilla sector.
Yeah.
That said, we do have some triple index contracts. There's quite a lot of dual index contracts. There is a large number of decrement indices that come and go. I think explaining the decrement index and its impact is expertly done by some people. Yeah. But this is where a lot of clients might just end up trusting the advisor. Some of the decrement indices I don't think they should be used in retail space.
Yeah.
Others like the CSDI, I think should be extremely common.
Okay. Look, let's talk about the future. And you mentioned these, right? There is mergers happening and consolidation happening on the advisor firms. What do you think it's going to happen with less advisory firms and those getting bigger and bigger?
I think streamlined process, centralized investment propositions, all coming to the fore. That will allow less individualism by an advisor. And in the UK space, with the plan model
Mm-hmm.
that we currently have, with occasional or regular issuance, clients getting the advice that is relevant at the time and the propositions and the offers that are relevant at the time, perhaps doesn't fit in a larger model.
Yeah.
So I think we will see a greater move towards funds, a greater move towards discretionary portfolios,
Yeah.
structured discretionary portfolios, which take away a lot of the pain, but they also lose some of the nuanced benefits of the structures that everything which is a benefit sometimes comes with a cost, but having to see 200 clients who all have the same investment in having to roll that over on an advice basis is something that you need a bit of a machine to operate. And we had a large workforce that were working around the clock to try and
Yeah.
ensure that everything was done on time. That's not going to work in a bigger organization.
No, but are we moving towards a model portfolio that includes structured products, or
I think a lot of model portfolios will already include structured products in various elements, whether the advisors understand that or not. Having a segregated part of that model portfolio which is dedicated to structures, it will need to be in a form which is manageable for that model portfolio. A series of individual autocalls is not going to fit that model. So therefore we move to, are we going to allocate to structures, we're going to use a fund, or we're going to use another element of a discretionary service which is going to provide that exposure.
but can't technology help, right? That adoption and increase the sophistication as well, the let's say the personalization, right, for clients, for investors.
It's going to have a benefit. The short-term adoption in the UK of structures in model portfolios in their current individual form, with or without technology, I think is just a barrier too far. And as I say, having individual structures has other benefits to the client and the client relationship and their relationship with their portfolio. Once it's lost in a model or even lost in a fund, they no longer get the personal pleasure of and the ability to being forced to make a decision as to whether I'm going to reinvest some or all of the capital, take some gains, etc. That part of the relationship and the client's relationship with the portfolio will disappear if we're not using individual plans.
I think that's extremely interesting because I was having a conversation about moving to, let's say, the structured funds or the separately managed accounts, which is, it's the client gives the money to the structured product expert, and the structured product expert does everything. They just need to report the statement. But someone told me, yeah, but Tiago, we love the communication and the life cycle of structured products, the communication with clients, being able for me to call a client, say, you're getting this coupon, you're getting this interest, what do you want to do? Should we send it to your cash account, or do you want to reinvest the proceeds? Should we change the allocation? How important is that?
I think it's crucial. I think it's crucial in terms of the benefits that structures have bought. If we're looking at structures as part of a portfolio allocation tool, part of an overall investment portfolio, great. I think they're going to do the job. I don't think they're going to disappoint. I think they're going to give the defined outcomes. That's great for the client, but you are losing something by doing that, in that they have lost that engagement. And that engagement, I think, makes a huge difference. And I think that's where we will see perhaps it's difficult to maintain that engagement in an advisory environment. Some will completely own it, they will use it. Others will look at this as a more of a complication or a frustration, and would rather do the allocation through some other method.
Yeah.
This is where I think the demand will arise for direct retail investment. The client will segregate this part of their portfolio and do it themselves. They will buy the structures. They will have an automatic engagement.
Yeah, it's so strange, right? Because as an UK investor, for me, I love to invest in structured products, but it's so difficult in the UK. It's so complicated. I need to print papers. I need to sign them. I need to send them. Thankfully, I don't need to. I think some people still have the fax number.
Yes.
It's It's painful. It's very painful.
Well, what I've been doing recently is I've been working on a project called Autocalls UK, which is designed to try and remove that paperwork. Where advisors can start an application form, issue a notification to the client comes in, finishes it, digitally signs it, it goes off to the custodian. The custodian will then acknowledge direct with the client and the advisor. Whether or not that gets to a point where it is direct to retail proposition will be dependent upon a little bit of relaxation of the regulations and the target market assessments. Having been there, having built the machine that was necessary in order to properly manage and operate the structured products portfolios for clients, I know what's missing in the sector. Some advisors will have very simplified operational systems where they are pre-printing applications and the client relationship's all great. But we are in a digital world now, and it needs to move to that. So I think making it as simple as possible is crucial.
Okay, so last question, which I have for you. What will surprise us about the UK structured products market by 2030 or 2031?
What will surprise us, or what would I like to surprise us?
Well, why don't you be optimistic and tell us what you like?
Right. I think simple autocalls, single index autocalls should and hopefully will become widely available. One of the big issues we have in the UK is the advice gap. We have moved to a point where 10% of the population are within a target market of most advisor firms. A substantial proportion of the rest have money to invest, don't want to pay for advice, don't know where to go, end up buying cryptocurrency or trading and perhaps getting their fingers burned and then reverting back to leaving their money lying in a bank account and not going anywhere. I think standard order calls could and should be a retail proposition on a mass market basis. No stings in the tail, nothing nasty, caution about counterparty diversification, make sure people understand the risks, but sitting somewhere between deposits and equities, order calls have a great future in the UK.
Okay, thank you, Ian. Let's hope that happens. I know you will be working for that.
Do my best.
Appreciate. Thanks everyone for listening, and once again, thank you, Ian. I really appreciate you coming here, give some of your knowledge, because education is key for advisors.
Yeah, I agree. Well, thank you very much. Appreciate the opportunity. It's good to talk to you.